Good afternoon, ladies and gentlemen. My name is Jeffrey Adams. I'm with the management team here at Vancity's Sustainable Wealth Division. Welcome to our presentation on retirement planning. Today's webinar is part of our Financial Literacy Month series, and we'd like to invite you to register for the other sessions in the series. We begin by acknowledging that Vancity operates on the unceded lands of the Coast Salish people, represented today by the Musqueam, Squamish, and Tsleil-Waututh nations. They've been custodians of this land for generations, and as visitors, we'd like to start by paying our respects to elders of the past, present, and emerging. A few housekeeping items. This webinar will be recorded and shared with registered attendees. It will also be posted to our YouTube channel following the event. As such, we've turned off incoming cameras and muted your microphones. You can follow us on YouTube and other various social media platforms to stay connected and get access to great content like this webinar. For those of you joining via desktop, please take note of the banner at the top of your screen. Here you'll find a variety of opportunities to engage with us. The Q&A button allows you to submit a question that will be reviewed for our post-event Q&A. We encourage you to engage with us throughout the webinar and take note of what's most valuable and what might be most helpful to you. I'd like to now introduce you to our speakers for this webinar. Sophie Salcido, as a wealth advisor at Vancity, Sophie provides investment advice and solutions tailored to the unique financial goals and objectives of each member. With more than 23 years experience providing financial advice at Vancity, Sophie specializes in helping members develop effective and practical solutions to meet their financial goals, such as retirement, tax, and estate planning. Sophie has a degree in business administration, is a certified financial planner, and holds the Canadian Investment Manager designation. Next up, we have Naji Nakna. Naji provides discretionary portfolio management services with Vancity Investment Management, or VCIM. Naji has been a part of the VCIM team since 2018, was the firm's chief compliance officer, and was a member of the firm's investment committee. He brings over 12 years of experience in the investment and financial services industry, is a chartered financial analyst or CFA charter holder, a certified financial planner, and a fellow of the Canadian Securities Institute. Up next would be Tim Lang. Tim has been a wealth planner since 2008 and loves connecting with members and educating them on the basics of financial planning. He is also a certified financial planner. Sophie, Naji, and Tim will talk about what you should consider before retirement, how much is enough for retirement, and what are the various sources of income during retirement. First up is Sophie. Please take it away, Sophie.
Thanks so much, Jeff. So thank you, everybody, for making the time to attend our seminar today. We hope you get some really valuable and practical advice. So I'm going to start with setting the stage for your retirement. And so what I want to touch on starting here is that we want you to be thinking about what your vision for your retirement will be. So we're going to ask you to think about, what do you want in your retirement? What things do you think you'll be doing? How much will you have to be funding during your retirement? What various income sources do you have? And then seeing about helping you plan towards achieving those retirement goals. So let's start with the 3 stages of retirement first, and we'll go on to the next slide. So we're going to talk about the 3 stages. So the first one we call active retirement. This is age 60 to 74, typically. Then we're going to have the next stage, which is typically the slowing down period. So 75 to 84. And lastly, we talk about the passive years. These are 85 years plus. And this is all, of course, dependent on each unique individual situation. Doesn't mean when you turn the year to the next calendar year that you're going to hit this stage. It's just giving you some ballpark numbers. And each of these stages has very different financial demands that you may need to think about and prepare for. So let's start with the first stage. So stage 1, the active years. So typically you're waiting to retire, you're there now, it's 60 to 74. So can be the most expensive time that you're starting your retirement. And so you're going to want to be thinking about, what hobbies am I going to want to be doing now that I have more time for? You're also going to think about demands on your lifestyle that you've now got some time to do. You've got less work demands, but maybe you want to see family or travel more. You're going to maybe want to buy some new toys or do some home renovations that have been waiting. And so these things are all going to add up. The one thing I would also say, when you're moving now into retirement from work, is you should be thinking about what you want to retire to. So in order to prepare for this stage properly, instead of just retiring from something, really start to think about what am I retiring to? So what are those activities I want to do to help you create your needs and goals and amount of money you might need to start saving. So the next stage is now the slowing down period. So maybe it's age 75 to 84. Sometimes expenses are overestimated during these years because we're still working with stage 1 expenses and we've just carried those through to stage 2. But it may be that you have slowed down, you're doing less expensive travel, you've got a less desire to travel actually, fewer hobbies or activities, a little bit lower energy level and slower pace. And I do often see with my clients and members that they'll sometimes come back after a big trip at some point and say, you know, that was a lot of work. I'm really tired. I think that's my last big trip. So that can be quite common. And sometimes it's within these years that that will be occurring for you. The third stage is what we're calling our passive years here. So this is age 85 plus. It can be, again, an expensive stage like stage 1. It can be also the most expensive stage of your retirement years. It's all dependent on individual circumstances, things like health, your activity levels at those age for you. And what you're going to want to be thinking about, of course, is where will and how will I spend those final years? So will I be actually moving into a long-term care facility? Will I have family helping me? Will I be needing or wanting in-home care for myself as I age? I've got members and clients who do have 24-hour in-home care, and of course that can be very expensive. Some of them are paying $10,000, $11,000 a month for that. So that gives you an idea of the amount of funds you may be needing to call on during retirement at that point. So now I'm going to pass the next section over to Naji in a minute here. The last slide I want to talk about here again is just reinforcing that retirement picture. So make sure you know what you envision doing. I think the best retirements are those where people have really planned for what they're retiring into and not just sort of blindly trying to finish work, full stop. And this will really help you plan better and know how much money you're going to need for those expenses and things you want to do. And I'll hand it over to Naji now. Thank you.
Hello, everyone, and thank you very much, Sophie, for setting the stage for the discussion today. And as Sophie mentioned, retirement is not linear. And so when you think about those decades of your life after you stop working and getting into retirement, there will be many phases. And by that, what we mean also is that planning for retirement or thinking about how you're going to finance maintaining those lifestyle will probably change depending on the phase of retirement that you're going to be in. So to that question of how much is enough, which is always, you know, two parts of the same equation. What do I need to preserve or in some cases enhance a realistic and sustainable lifestyle in retirement? And then what do I have to finance that amount, which is what my colleague Tim will discuss in a few minutes here. So what we're going to do in the next section is go through a few of those tools that you can use to get started on what you need for retirement when you talk about preserving that lifestyle. And we're going to go through 3 methods or tools to get that starting point. And you will see in those different methods, depending on the stage of life you're in right now, the time distance that you have from now to retirement and the amount of information that you have available that you can use one or combination of those tools to get that starting point. So starting with method 1, which is the percentage of current pre-tax earning, this method is really more of a rule of thumb or indication here in the absence of other information. If we can move to the next slide here to just have a quick look at that. And so we would take a range of 60 to 75% of your current pre-tax earnings to get a figure of what is generally accepted to be realistic as a number to maintain that lifestyle in retirement. That range of 60 to 75% is supported by very solid evidence, empirical and statistical evidence. And so it's, an approximation, but a good rule of thumb to get started. Obviously, as Sophie mentioned, retirement is really subject to each individual situation. So that approach will work for some people. Some people will need more advanced or accurate information, which we'll see in other methods. It's generally used as a guide only, a point of reference to get started, and generally would be used as you are farther away from retirement and you don't have a lot of data or information, you don't have a clear picture of what retirement will look like generally in the earlier stages of life. So on the next slide, we'll look at how it looks, which is very straightforward as a calculation. You would take your current pre-tax earnings, that's the left column there, and do a multiplication by 75% and get an approximation of your retirement needs. Obviously here, it can be done on an individual basis. You can also do that same calculation on a household basis to get a sense of what those retirement needs would be. One thing we generally mention here when you look at the range between 60 and 75% is that it's probably safer to be more conservative on that number when you work on planning and projection. And in this context, being more conservative would be taking the higher side of the range. So 75% in that example, because when you do further analysis, if you can sustain that higher range of 75%, you can sustain between 60 and 75, whereas if you're a little tighter at 60%, it's going to be difficult if it turns out that you actually need closer to 75%. So on the next slide, some of the comments and drawbacks here of using that method. It's not the best method to use because obviously it's an approximation. We don't have a lot of information available. We are farther away from retirement. We don't have a clear picture of what it's going to be. So there could be a lot of variance here between the number we get using that approach and what the reality may be. It's also probably more appropriate for average income earners. And by that, one of the examples here, when we saw the table on the previous slide, is that when you get to lower level of incomes, there's going to be a threshold here that doesn't really account for what we could call a minimum living income. And especially in BC, where the cost of living tends to be higher than the rest of the country, it's a question of whether or not you can afford retirement here. If you have, on the lower end of the calculation here, 20,000 per year on an individual basis, do you look at that calculation on a household basis? So there's going to be a little bit of the discussion that is valuable to have with, financial advisors like ourselves at Vancity to have a more realistic sense of what could be expected here. It also does not account for income taxes, nor does it account for special expenses, one-time lump sum expenses at retirement, whether it's a big trip being taken, renovations on the house, or anything like that. So that's the first method, the percent of current earning. A more detailed and accurate method now, which is the current net income less expenses not required at retirement. Generally here, you're a little more advanced in your life cycle and you're looking more towards that retirement goal line as you are 10, 15 years away. You have a better sense of what the picture looks like. You have also a better sense of what is not going to be needed in retirement and whether it's work-related expenses in terms of transportation. Do we need to go from 2 cars to 1 in retirement? Maybe we don't need to commute anymore. There's a lot of deductions from your income that will not be needed anymore. Some additional RSP contributions, you would have maximized those already. You're not going to pay union dues. In some cases, it's going to be expenses related to children education or so on and so forth. So you have an idea here maybe of what will not be needed in retirement, and do a little bit of an exercise trying to subtract those no longer needed expenses from your current net income. An example that is given on the next slide here. So we take a household of 2 people and their total income after tax. And from that point of reference, deduct those expenses that they will deem no longer necessary in retirement. So we talked about that already. Children education, for example, mortgage payment, if the house or condo is already paid off, commuting, some additional contributions here, and you get a calculation of what the net income in retirement would be needed, and then extrapolate that to a pre-tax income requirement here. In the example that we show on the slide, so we took 100,000 combined for the household and got a result of 75,000. If you recall a few minutes ago when we were talking about taking an approximation in method 1, and we talked about taking a range of 60 to 75%, you will see that this is also realistic here when we take a more detailed approach. So in this case, for example, we would be at 75% on the calculation here. So that's the second method. It's more accurate than the first, but you need to have a clear idea of those amounts that will not be required in retirement. So that usually assumes that you're closer to retirement than when you, for example, get started in your active life, or you're already 5-10 years in. You also need to know any new expenses that will be required at retirement. So in the example and the discussion, we only deduct expenses that are known and no longer needed in retirement, but we didn't add anything new. And in some cases, it's going to be a different type of activity, some new hobbies, some changes in the housing situation, some additional help that you want to provide to a child, or maybe you're going to start taking care of elderly parents or something like that. So it requires to think about those two sides, deducting some expenses, but also maybe adding some new ones. And now getting into a third method, which is probably by far the most accurate method, but requires the most work on your part, and also the most detailed information, is to take the approach of essentially putting together a budget of what exactly will be needed in retirement. So either on a monthly basis, on an annual basis, and traditionally, and maybe you've done that already in your current situation, when you do that type of budget, it's really itemized by line of spending into a worksheet or spreadsheet form. And we have an example of that on the next slide, just to be clear of how it looks. And so you would itemize all those items, for example, relating to housing and utilities, transportation, discretionary spending, healthcare, and try and break that down to the most accurate amounts that you can think of, again, on a monthly or annual basis. And if you need help with that tool, just want to mention that we have some of those worksheets and spreadsheets available on the Vancity website. I think there's going to be a reference to that at the end of the presentation. So you can have an example of that and start working on it if it's more appropriate to your stage of life and to the approach that you want to take here. So if we can move on to the next slide here. Again, it's working from the ground up, and we'll also suppose that you have a very detailed idea of those lump sum and one-time spending in retirement. So you can maybe break them down either by a specific year or amortize that expense over a number of years. And here we give some traditional expenses we see and discuss with our clients, usually some home renovations, adding or subtracting a vehicle, financing a child wedding, for example, taking care of parents, going on a specific vacation. All those could be estimates, but usually using some type of accurate information and data, try and break that down into a budget form. In all those cases and method and approaches that we've discussed here, the idea is really to try and translate that retirement picture that Sophie discussed a few minutes ago into financial terms and get into a number that would be realistic as an estimate of what it's going to be needed to finance or maintain that lifestyle. And so now our colleague Tim will discuss. So we have one part of that equation, what is needed in retirement, but how are you going to finance that? What are your sources of income? So you can have getting into that discussion with your financial advisor, wealth planner, into what is realistic here and expected to be financing those needs. Tim, take it away.
Thank you, Naji. In your retirement, there will be there will be various sources of income, which is quite different from in your career generally, where you only have the one income from your work. So in your retirement, there are three different parts of income that come to you. Number one is money that comes from the government. And so we'll talk about that a bit. And number two, the money that comes from your employer, whether you've got a pension or not, and that's a part of your plan in building that budget for yourself. And then when we get to personal savings or income, we'll have Sophie come back and talk about that part. Okay, so with the government income, the first section of government income would be your Canada Pension Plan. Now, this one is self-supporting, and what we mean by that is from your paycheck, if you're an employee, you'll notice that you have some deductions going into CPP, and your employer also has money that goes into the CPP for you. If you're self-employed and you decide to participate in the CPP, then you'll notice that you're charged for both sides, employer and employee. So these contributions to your Canada Pension Plan are based on your employment earnings over the course of your career, and it is managed by an investment board. So with the Canada Pension Plan, if you have always paid in the maximum amount every year of your career that you qualified, and then you are collecting it right now at age 65, you would be collecting the maximum, or $1,253.59 every month. Not everybody has the kind of income that gets you to the point where you max out your CPP every year, and some people have a much lower income than that. And these days, the average Canada Pension Plan that retired seniors are collecting is somewhere just over $700 a month. So the best way to know how your Canada Pension Plan is going to work for you would be to contact Service Canada, and we'll be providing some information for you at the end. In addition to these monthly plans that will be coming in for your retirement income, there are survivor benefits. For example, if you didn't reach the maximum, but you had a spouse who passed away, then their CPP could be added to yours. And again, it's very custom tailored to the individual. So you would want to learn more about that for yourself. And also as an ongoing benefit up until age 65, if one is deemed to have a disability that qualifies for this pension, there is a disability pension, Canada Pension Plan as well. So important things that you'd be wanting to look out for with regard to your Canada Pension Plan and how that is going to be a part of your retirement income would be a record of earnings. And when you contact Service Canada to get your personal record of earnings, you can see what you've paid in and what their target or it looks like your trajectory would pay out if you continue on doing what you're doing and earning what you're earning and paying into it what you're paying into it. There is a contributory period that basically starts at age 18 and follows you through all of your career up until the time that you apply for the CPP. And there are provisions where you can drop some of your lower income years out of the calculation to hopefully increase your personal CPP benefit. It is taxable, so you do need to plan for how to pay tax on your Canada Pension Plan as a part of your retirement income plan. And when you go to apply for your CPP, you would apply either in writing or online. Now, with a Canada Pension Plan, you've got a few options, and this is another reason why it's so good to contact Service Canada to find out your custom tailored options. If you wanted to take it early, somewhere between age 60 and 64, there is a calculation that is essentially going to reduce your benefits by 0.6% per month that you take it before age 65. But when you figure that out, that may be something that really benefits you, or it may be something that doesn't benefit you. Pretty much when you apply for your CPP and you start to collect that, that is what you're going to get, more or less, with slight inflation increases for the rest of your life. If you take it at 65 straight up, then you'll just be getting your normal benefit based on your contributions over the course of your career. Now, there is something on the slide that says PRB. That's a post-retirement benefit. So what that means is if you are collecting your CPP and you're also working still, and you're not 65 yet, you're going to have to continue to pay into the CPP, and that's called the post-retirement benefit. And the way that works for you is it will increase your benefits year by year moving forward. If you are 65 plus and you're still working, then you have the option whether or not to pay into the post-retirement benefit. And then if you wanted to defer and delay collecting your CPP beyond age 65, then they sweeten the pot a bit by adding 0.7% per month past age 65 to increase that benefit or give you a premium to your CPP. And you can wait up until age 65 to apply for your Canada Pension Plan in order to get a higher income, if that makes sense to your plan. So these days, when you approach Service Canada and you start working toward your application for your Canada Pension Plan, you don't have to prove anymore that you've stopped working. You can simply apply for it and just take your Canada Pension Plan. It can be added to your current income, or it can be just a part of your retirement income if you aren't working. And we talked about the post-retirement benefit already, and there's an increasing number of your low-income years or the years that you want to drop out, perhaps because of child rearing. so that again, your personal benefit could be increased by spending the time to work with Service Canada to figure out which years you should drop out. And these changes to take your CPP early or late, those are some of the more recent changes that have come for the Canada Pension Plan. And you have most likely noticed on your paycheck over the last several years that the percentage that's being withdrawn and sent to Canada Pension Plan has probably, well, it's definitely increased starting in 2019. And the target rate is 5.95 for your deductions and 5.95 for your employer deductions. And then coming in 2024, there is going to be a new ceiling up and over today's current maximum. So let's stay tuned and see how that goes in 2024. And then we've got some contact information here, and I believe this information will be made available to you after the presentation as well. So the next piece of your retirement income that will be coming from the government is the old age security. Now this one is financed not from your contributions, but from general tax revenues that the government is always collecting from us. So one of your benefits for paying tax in Canada is that you're going to get the old age security benefit. Most likely. So currently, from every conceivable angle, the old age security is on solid ground. You can't take this one early, but you can take it late. And there is an automatic enrollment that may happen for you. If that's the case, then you'll get a notification the month after your 64th birthday to let you know that your old age security is going to start right away. So if you don't want that to happen, then you would need to contact Service Canada again to talk to them about this. And if you defer your OAS, you will be getting an increase or a premium added to it of 0.6% per month. Up to age 70 is when you wouldn't get that premium anymore. So it wouldn't make sense to defer beyond age 70. Okay. So one thing that is factored in for your particular old age security would be your legal status and your residence status from age 25 to age 65. And if you have lived in Canada with resident status from, for all of those years, you would essentially get 100% of the maximum benefit, which right now would be $642.25 every month. Now, if you haven't lived in Canada for all of that time, but have lived here for at least 10 years, then there would be a fractional amount that you would get. Like, for example, if you arrived in Canada when you were 26 years old, you're missing 1 year in the calculation. So you would get 39/40ths of everybody else's benefit. So if you haven't been here for all of those 40 years, again, that's one of those really great reasons to contact Service Canada and figure out your numbers and your benefit. And then, like Naji was telling us, when you know these parts of your budget, then you can plan for hopefully that ground up approach to your retirement budget and your retirement planning. And the last point we need to talk about on the old age security is it is taxable income. That's one of the most common questions that my members ask me is, I'm retired, I'm 65 years old, I'm getting this benefit, why would it be taxable? It just is. So when you're collecting it, it's a great thing, but you need to plan for paying some taxes on that. Okay. And again, here we're sharing the contact information with you. And it is, I believe, very important for you to contact Service Canada to get your own calculations and your own numbers so that you know really what to expect from this. Okay, so we talked about 3 different income sources. One would be the government, 2 would be your employer. So some people are fortunate enough to have what we call a defined benefit pension. And what that looks like is you work for an employer who puts aside money for you every year that you have work with that employer throughout your career. And it becomes a lifetime pension. And the benefit here is that on a monthly basis, you know what you're going to have to help you build your budget in retirement. It isn't going to fluctuate because you will be getting the same thing every month. So you can really count on this kind of a pension. There would be the normal retirement age, generally 65 for in most cases. Oftentimes, your employer or the pension board will start giving you statements on an annual basis to let you know what your pension is looking like and what your projections are looking like. And there are sometimes provisions where you can retire early. And if you do retire early, what percentage of your pension would you expect to be able to collect for the rest of your life? Um, Oftentimes, if you are single, then you would most likely want to just take the plain straight up pension that is offered because that tends to be the greatest amount on a monthly basis. Some of them have guarantee periods in there. What that looks like if it's a 5-year guarantee, for example, is if you unfortunately pass away 14 months into your retirement, then the remainder of that 5 years, starting at your retirement until the 5 years are up, would go to some beneficiary in your life. So that might be something to look at when you're looking at your pension options and signing up for which pension option fits you best. Many times there's a joint life option that you can choose with your pension. And if you're in the kind of family where you've always done the finances together, you've always done your budgeting together, it would be a really unfortunate thing to lose a spouse and a significant chunk of income. So working with your planner to help you perhaps decide which pension option is best for you might be a really good use of your time. Um, Now, there's something called bridging in pensions, and that is typically if you retire before age 65, then your employer would add a certain amount of cash every month to bridge or sustain you financially until you turn 65. And then that bridge would fall out or just stop being paid in conjunction with you being able to apply for your old age security, and perhaps you've waited to get your Canada pension plan until age 65 as well. So then those government funds replace the bridging option there. And another thing that would be really important for you to look into with your pension is whether or not that pension is going to be indexed to inflation or whether that amount that you start with is going to be flat for the rest of your life. And it's really important to have some form of planning in place for your retirement, thinking about how inflation is going to affect these dollars for you as you move forward into your retirement. And the last part of retirement income that I wanted to share with you today is some of your employers, some of our employers have a defined contribution plan. What that looks like, what that means is that exactly that. The contribution, the amount that gets put into an account for you that's the part that's sorted out. That's the part that's predictable. And then typically you have to make decisions about how that gets invested, whether that's in something secure that may or may not keep up with inflation, or whether that's something that is going into the market and might have some volatility there. So this is another reason why, if this is the kind of plan that you have, you might really benefit from having some really great advice from one of our wealth planners or one of our advisors here at Vancity. Now, when it comes to retirement, if you have this kind of an account, whatever that final value is that you have accumulated by the time you retire, you would be able to put that into some sort of an annuity or a RIF that would give you payments for however long it would last. But there is that danger that some people have a little bit of fear, perhaps, that maybe it's not enough. Maybe that plus the government pension can't sustain you. And so on that note, that's where I want to launch into this last section, where Sophie's going to help us talk about personal savings and personal income to supplement these other pensions that that we've built.
Thank you so much, Tim. So yes, we'll touch on 4 types of personal savings or income that you could draw on. We'll touch on an RRSP, Registered Retirement Savings Plan, the tax-free savings account, and non-registered assets or savings, and then some final tips on some other personal sources you could consider. So in regards to the first one, the RRSP savings plan, I think many of us are familiar with RRSPs. We would be putting money in there while working to reduce our taxes owing, getting a tax refund, and then drawing the money back out during retirement when hopefully the income tax bracket has dropped. And I get a lot of questions about what is a RIF. So in very simple terms, you have an RRSP for some people. You decide that you don't decide, I should say, you're told, you're mandated to move the money into what's called a RIF, a retirement income fund. You have to do that in the year in which you turn 71 by the end of the year. And I would just consider it 2 different umbrellas. The investments move over as they are from the RSP into the RIF. And we plan your payment stream. And there will be a minimum payment that has to come out, no maximum. The other option you have with registered retirement savings funds is you can roll them into what are called registered annuities. And here you would have a set payment stream and less control over how to invest the assets, but know that you're getting a guaranteed payment amount. The next plan to touch on is locked-in RSPs. Not everybody would have a locked-in RSP. This would come to you if you leave an employer early, you're leaving their pension plan, you've had a pension plan available, and you're changing employers. You can try to withdraw the funds from the pension plan. It would go into a locked-in RSP. The difference with this one is there's a minimum you have to take out once you're 71 and older, but there's also a maximum cap. So these plans definitely need a bit of planning around them. There's some interesting ways to look at how to invest them, different parameters around them. So you need to get some advice from an expert around that to know how to draw that out properly for yourself. And there's also, again, registered annuities that you can have with registered retirement income fund and locked-in income funds as well. The next option has grown in popularity. Of course, that's our tax-free savings account plans. So here you can deposit money that will then grow tax-free. You can take it out at any time without paying tax on it. It doesn't affect any federal government benefits, which is nice to know for later. The limit currently, I get asked that a lot. So the current limit, if you're of eligible age when the plan started, is $81,500. These are going to become quite important pieces for many people's retirement income as the years go by. And we wanted to let you know the new limit is $6,500 as of January 2023. So that went up by $500. I would also consider them an estate tool. So many people don't think of it this way, but if you have money in a tax-free savings account you do not need for your own retirement and you pass away, that will roll over tax-free and no probate also to your beneficiary, which could be family, a charity, or whatnot. So you can think of it as an estate tool. The next one we just called non-registered assets. This would really just be savings you have that are not in an RSP, TFSA, locked-in RSP, those other types of savings. The next slide I'll show you here is about other sources, and I think there's some interesting things here. So you could work part-time during retirement. We've been seeing through Stats Canada and CRA that there's a lot of retired people who go back to work because they want to use their time. They're missing some stimulation, some colleagues around them. So that's a great way to draw on some additional income if you're able to work. Business income, people retire and then tend to go back and start a business sometimes, especially if they're looking for tax write-offs. Again, another little source of income they might want to rely on. People may downsize their home, so move to a smaller home, take those excess funds from your sale and draw on those during retirement. And rental income can be popular as well. So you can rent a suite if you have one in your home. You could rent a bedroom to somebody and just to draw some extra income. That's all helpful. So those are some things to think about for retirement income sources. And just to summarize now, I would again remind you, envision your retirement. What's the picture look like? Try to think about what you're going to need in terms of spending, and in after-tax dollars is important. And always know that you can go to our vancity.com website. We have some really great calculators and tools. And please feel free to reach out to our team, the investment specialists, the account managers in your Vancity branch. We're here to help you. And I can pretty much want to say, I guarantee if you come in to talk to somebody, hopefully you'll walk away with at least one tidbit you didn't know to help improve your situation. And I'm going to pass it back to Rabinder now, our moderator. Thank you.
Thank you. Thank you, Tim, Sophie, and Naji. All the information you just provided, it's so helpful when we're trying to navigate our retirement. I really appreciate it, and I'm sure everybody that's watching our webinar appreciated that as well. I am Rabinder Dasanj Sangha, and I'm going to be facilitating the questions that our audience has been posting during the webinar. So first question, I'll ask you, Sophie. So I'm close to retirement, and now with market volatility and inflation, I feel that I'm not in the financial position that I thought I would be in. What should I do?
That's an excellent question. I'm sure it's on many people's minds. We hear about this a lot in our conversations. So everybody's situation is unique. I never want people to feel futile about things. There are actions you can take. I think it's great to come in and get some advice. I would really want to look at that individual situation to see where maybe we could save some money for you. Are there other tips we could have you consider? And really need to look at your planning picture in terms of where you are invested at the moment. What is going to make the most sense? I definitely would not encourage anybody to go all of a sudden very high risk at the moment to try to make up for lost time. You need to think about the pros and cons of each decision. And I think someone with a planning perspective like we have can sort of show you what's worked for other people, what's not worked, and help you put a new plan together.
Yeah, and next week we do have a webinar diving deeper into markets. So that'd be a great webinar for those that do have market questions. Tim, I'm going to actually direct the next question to you. So thank you. When should I start using our RRSPs?
When I'm helping somebody with their plan, what I'm really looking for is when is the income going to drop? Not necessarily waiting until age 72. If you happen to retire early, you may have a few really low income years in there. So what I would encourage you to do is work with your tax accountant and your tax planner and coordinate that with the advisor that you're working with here at Vancity so that we can work together to come up with your custom tailored plan for your RRSPs and making them work for you.
Perfect, thank you. Naji, when should I start planning for retirement?
There's only one good answer to this one: as soon as possible. And we always joke about this. It sounds like a gimmick saying that, but really, when you stop for a minute and start thinking about it, the most important thing that you can control here, because none of us can control interest rates or inflation or market return, but the only thing you can control here is when you're going to get started and what amounts you can try and save for that retirement. And there's a couple of sayings here, not to use cliches, but think of it as, pay yourself first. So once you've answered all these obligations to finance your lifestyle and you pay your taxes, pay yourself first by prepaying your retirement years, getting to those savings as early as possible. Time is more important here than an exact picture, as we discussed, of what's going to be needed, what type of investments, or going into too many details here. The other idea here, using time as the key word, is that you've heard that also compounding interest being considered the eighth wonder of the world. And so that idea conceptually, that when you invest some money, as time goes by, you earn returns or interest that compounds over time. So you invest $100 first at 5%, get $105 at the end of that period. The next period, if my math is correct, you don't get another $5 of income, but actually 5.25% dollars. So it doesn't seem, when you start investing, especially very early, like much, but over long periods of time, again here, depending on where you are in your stage of life, we can talk about decades, 20, 30 years, all of that matters. So if you can afford it, and here we always want to refer to individual situations, all things being equal, debt levels to be managed, specific cash needs. But if you can afford to save, then use those tools put at your disposal by your employer or the government in, tax advantage accounts. Sophie mentions RSPs, obviously, you can deduct those contributions from your income, TFSAs, other type of vehicles here that will help you along the way. And obviously, financial advisors, wealth planner, portfolio managers at Vancity can help you get a better sense of what that would look like. Again, as soon as possible, if you can, would be the best answer here.
Fantastic. So we should be calling you as soon as we end this webinar. That's what I'm hearing.
Yes,
Sophie, I'm going to direct the next question to you. What considerations should I be aware of if I'm interested in income splitting opportunities?
So income splitting is used very, very much in terms of the spousal unit. So you'll want to come in and take a look at some investment advice and see what you can split, actually, that you do have in terms of income, that what is splittable, so to speak, and also working with your accountant. So some years maybe you don't need to income split, some years you'll want to income split, but really what we're trying to do is bring you both down into a lower, more even income tax bracket by shifting some income over. And something like RIF income is something that you can divide up between a spousal unit, and pension income as well. So you need to get a bit of advice, and it's an excellent, excellent tool to reduce taxes.
Thank you. That's really good information. Tim, what are the considerations if I want to start early or delay my CPP?
It really comes down to the budget planning that you're working on. If it, in many cases, it might just not be the right thing to apply for your Canada Pension Plan early. If you are still working and you're still making $80,000, $90,000, $100,000 a year, you're looking at a very big tax bracket for that extra income to go into. And so you really might not want to apply for it early. Whereas if you are retiring early, you have a fairly low income, and you're able to live on a smaller Canada Pension Plan for the rest of your life, it might really start making sense to you. Now, on the other side, deferring, nobody knows how long we get to last and how long we get to live. But if you have really strong, very long genes, longevity in your gene pool, that might be something to look at, is deferring your CPP. Also, if the savings that you've been able to build is not what you were hoping for, or if your pension is less than you were hoping for, this might be something that would slightly help Because again, once you start that Canada Pension Plan, once you start taking that, that's pretty much it for the rest of your life. So, you know, from age 70 to age 105, you might like a bigger income. So it really depends on, you know, like from Najee's presentation, working on that budget from the ground up and putting it all together, building that and figuring out what are your needs, what are your options from Service Canada, and then how should you apply for that.
Perfect, thank you. I know we're nearing the end of our webinar. I do have one other question, but I guess it could be a long answer, but I have a short period of time. So whoever could answer it in a short period of time, please take this question. What considerations should I think about to convert my RSP and start withdrawing from my RIF? Should I wait until I'm 71? Najee or Sophie, when do you want to take it?
I can definitely take that one, Ravinder. So just to build on what Tim had said just a few minutes ago about that idea about it's a good idea at times, you've got to review your situation. But if you have retired early and you're going to have a gap from your retirement, let's say you've actually stopped working in your 50s, we don't need to draw your CPP maybe till 60, 65, but it is actually an option and a good time to consider taking out your RSPs early and drawing them at this somewhat lower tax bracket before government benefits kick in. And you don't have to open a RIF right away. You can do some RSP withdrawals to test the waters out, so to speak, and see how that's working for you, and then decide if you want to open the RIF at a later point. But there are some good planning tools that I'm sure all three of us are doing in terms of drawing those RIFs out early. And so that's something you've got to come in and have a talk about. We are seeing our RSP plans for many clients are getting larger these days as there's less pensions coming from employers and companies. And so we are needing to be more strategic about how to get those dollars out in a tax efficient way. Thanks, Ravinder.
Oh, thank you. Thank you. And this does conclude our question and answer period. And Jeff, I'm going to pass it back to you to conclude the webinar. Thank you.
Thank you, Ravinder. Great information. Thank you, everyone, for attending today. Thank you, Sophie, Najee, and Tim for presenting. Once again, as a reminder, these webinars are recorded and are available on our YouTube channel if you want to revisit the topics discussed today or in any of our other presentations as part of our financial literacy series. A copy of the recording will also be emailed to everyone who registered, whether they attended or not. Please join us next week when my colleagues Mark Sheard from VCIM's equity team and Wes Dearborn from VCIM's fixed income team will give an update on the current financial market environment. We really appreciate you taking the time out of your busy schedule to join us, and we hope that you find these sessions beneficial. Please reach out to a Vancity Wealth representative if you would like to discuss your personal financial situation further. Thank you, everyone.